Hello everybody, this is Alan Ellman, the Blue Collar Investor. In this video, we're going to discuss setting up our covered call writing portfolios using the BCI Premium Member Stock Reports and the Elite Plus Calculator. Now, as we go through this, we're going to discuss an overall way of constructing our portfolios, keeping in mind that there are many ways to do so based on what our strategy goals are and our personal risk tolerance. Now, no matter how we craft these portfolios, in order to do option selling, we must first master the three required skills. What stock or underlying security are we going to use? Could be an exchange-traded fund. Second, what option are we going to select? And third, once we enter the covered call position, how do we manage our trades? So all three must be mastered before risking even 1 penny of our hard-earned money. In this video, we're going to focus in the first two, stock selection and option selection. And then we're going to use the Elite Plus calculator to evaluate our individual and total portfolio positions. Now, in our BCI methodology, there are three-pronged screens to our stock selection process. First, fundamental analysis, sales and earnings growth. The reason that this is so important is because the institutional investors love stocks with very strong fundamentals. So if they do, then we should as well. We're also going to do some technical analysis in terms of trend identification and momentum. So we're going to be using 4 technical parameters in our technical analysis. All this will be inherent in the premium member stock report. So you don't have to do all the screening if you become a premium member. It's done for you by the BCI team. But should you decide not to become a premium member, I teach you how to do this. I'm 100% transparent. In all my books and DVDs, I show you exactly how we do this process. And then third, common sense principles is the third aspect to the screening process. Things like minimum trading volume, avoiding earnings reports, diversification, asset allocation. We'll discuss those as we go through this video. And we're going to use the BCI Premium Report to get all this information in one place. Now, if we took a look at the BCI stock report, those of you who are members know that there's about 18 to 20 pages on these reports, but really half that, because the second half is the same report in larger font to assist those who are visually challenged. But this area over here, the top blue bar, represents that three-pronged screening approach. Some fundamental screens, we use the IBD Smart Select. Also, in terms of where we get these stocks from, the IBD 50, the IBD large cap 20, and so on. So there's resources that include fundamental screening of the stock. And then we also do technical screening like trend and momentum with MACD histogram and stochastic oscillator. For purposes of this video, we don't have to go into a lot of detail, but suffice it to say that the report screens from fundamental, technical, and common sense perspectives. And then all the stocks in the white cells become eligible securities for that contract month. Now, since this video is being made mid-contract, that means we are only going to select stocks that have weekly options. And so this column here becomes very important, because if we want to go 1 month out and we're starting mid-contract, the only ones that we could do that with are weekly options. If we were at the beginning of the contract, then all the stocks would be eligible that are in the white cells. So for example, over here, this would be eligible, and this would be eligible, and these two, but not these two. But again, we're showing you how you could use these reports to craft the portfolio based on your particular goals and when you're entering your positions. Most of the time, we'll enter it at the beginning of a contract, but in this particular case, we're entering it mid-contract. So we need stocks with weekly options. So that's all this information that we talked about in the screening comes directly from our premium member stock reports. Now let's go over the contract assumptions. This can be adjusted based on your particular situation, but here are the assumptions we're making. We're starting with $200,000 cash available in the portfolio. It could be way less, it could be way more. We're going to diversify with anywhere from 7 to 12 stocks. That's a reasonable amount to be diversified with a $200,000 portfolio. If we had a $50,000 portfolio, we'd probably just look for 5 stocks. 300,000 or higher portfolio, we'd probably look between 15 and 25 different positions. And also depending on what your comfort level is. For me, it's between 15 and 25 positions, and I sell between 50 and 100 contracts every month. Now, after we buy our stocks, it's important that we have cash left over for possible exit strategy maneuvers. So we're looking at 2 to 4% of our total portfolio net worth. So for 200K, that would be between 4,000 and 8,000 cash reserve. So when we're purchasing our shares in 100 share increments, we have to keep that in mind. Now we also have to define what our initial time value return goal range is. Otherwise, how do we know what strikes to select? And for me, it's 2 to 4% for a 1-month return and up to 6% in a bull market. I never go higher than that because the higher the return, the greater the implied volatility of the underlying security, which means the greater the risk. So for my personal risk tolerance, 2 to 4% normal market conditions, up to 6% in bull market conditions. Now, as far as strike selection is concerned, we're going to use 1 month out. Again, we're going to use weeklies because we're starting mid-contract, but we're going to go 1 month out. And we're going to use out-of-the-money strikes predominantly, which is what we favor in normal to bull markets. In a defensive or bear market or volatile market, we would favor in-the-money strikes. I will show you what one in-the-money strike so you could see how the Elite Plus calculator works when we're using in-the-money strikes, just to be thorough with this particular video. Once again, we're going to use weekly since we're starting mid-contract. Now let's talk about some specific portfolio requirements. Because we're going to be using between 7 and 12 stocks, and we have 200,000, we want to keep the price per share in the 200 and lower range. You know, we can't use a $500 stock, and that would cost 100 shares, 50,000. It would weigh too heavily in a 200,000 portfolio. So we're going to keep it, when we look at these stocks in the price column, you'll see in a moment, to 200 or low 200s and lower. We want to make sure that these stocks offer weeklies because of the nature of when we're starting, and we want to go 1 month out. We also want to make sure that that these stocks and their options meet our golden rule of never selling an option if there's an upcoming earnings report prior to contract expiration. So we also in our reports have columns for when the earnings release is due. We want to make sure the options have adequate liquidity, which is an open interest of 100 contracts or more. And we have a column for that in the report as well. And as I said, the report will provide all the information needed to meet these portfolio requirements. Or if you have different ones, you know, you could craft your portfolio based on what your needs are and what your strategy goals are. So here is a sample report dated 7/31/2020, and it's for 9/4/2020 expiration. So just a few days more than a 1 month return. Now, on this spreadsheet here, I circled on the top some of the key things that we need based on what our requirements are. So we talked about the price not being way more than 200 a share. So we have the price column. And the 3 columns on the right side of the spreadsheet here, we have an earnings report column. Are weeklies available? If there's a Y, that means yes. And near the money strikes, an open interest of more than 100 contracts. So when you see a Y there, that means it does. If it had an N like over here, then the liquidity for the options is not adequate at that point in time. Now, what we did was we checked the report for stocks that met these requirements. And on this particular segment of the report, you could see that there were 3. I think we're going to end up with a total of 8, but 3 of the 8 from this particular section of the report met our requirements. So we have AMD, DHI, and PayPal, PYPL, did meet our system requirements. So what we did was we then went through the rest of the report, and we came up with these 8 stocks that met our requirements. Taiwan Semiconductor, Microsoft, Pulte Group, Advanced Micro Devices, DR Horton, PayPal, and Take-Two Interactive. So those all passed our screens. And once again, keep in mind that this portfolio for this video makes good sense, but if your goals are a little different, your personal risk tolerance, your requirements are a little different, use the report. We go through thousands of data points for every stock report that we produce. And that gives you the flexibility to create a portfolio based on your specific needs and goals. Now, as far as option selection is concerned, out of the money mentioned before is appropriate for normal to bull market conditions. You have to identify what your initial time value return goal range is, in this case for 1 month options. And for me, it's 2 to 4% a month, and I'll go up to 6% in strong bull markets. If you're more conservative, you would lower that. If you're more aggressive, you would raise it. Now, the option liquidity, once again, 100 contracts or more. We also add in our books and DVDs and/or a bid-ask spread of 30 cents or less. So sometimes liquidity is a little under 100, but the spread isn't that great. So it's still okay to go ahead and use that option. These are guidelines. So, you can veer a little bit from these guidelines. And the report, once again, does provide the open interest information. Now, once we made our selections, we then go to an option chain. This one is taken from cboe.com. A good group of guys that provide a lot of great option information. From time to time, they ask me to do webinars or panel discussions for them, and I'm happy to do so. But this is taken from that website, and we can see here that TSM was trading at $80.19 when I made this screenshot. And we're going to look at the out of the money 82 strike, so out of the money, which generated $2.70. Now, how did I know to look for this? Well, if our goal is 2 to 4% and up to 6% in bull markets, we know 1% would be 80 cents. So 2% would be $1.60, 3% would be $2.40. Here we're at $2.70, so it's a little over 3%. So you can kind of figure it out that way. Go to 1% and work your way up or down. You could see here an open interest of 138, so that's adequate for, and we knew that from the report. So that's just, we did this for all of the 8 securities that I alluded to before. And now we're going to then set up our portfolio based on cash allocation. So we have asset allocation. We have 8 different securities, which is pretty good. And we're going to then allocate a similar amount of cash to each position. Now, it's never, ever, ever going to be precise, but we're going to come as close as we can. So here's how we do it. Since we're doing 8 securities, now keeping in mind we need a little extra cash for exit strategies, but we're going to start off with the framework of putting $25,000 per position. Okay, that's our starting point. Now we take the price per share and divide it into 25,000, and that will give us a number of shares. Now, because options consist of 100 contracts, we're going to round that number off to the nearest 100. In this case, for TSM, 300 shares, which means we're going to sell 3 contracts. Now, how much will 300 shares cost us? $24,057. Pretty close to the 25 goal. Now, we do that for all 8 of these securities. And on the first go round, it came out to where we're spending 182,300, leaving us cash reserve of 17,700. Now, if we were 2 to 4% cash reserve, that would mean 4 to 8,000. So we're much higher than we need. So we can actually afford to buy some more stock. Now, since AMD is trading at 85.04, we're going to buy another 100 shares of AMD. And instead of 300, we're going to make it 400. And that will about halve the cash reserve. So we'll have adequate cash reserve and will allow us to invest a little bit more. So here's what our final portfolio construction will look at as we move to AMD from 300 shares to 400 shares. And that means we're going to spend 190,804, leaving us a cash reserve of 91.96. That's much closer to what our target is. Now, we're now going to use the Elite Plus calculator, which, as you can see from this overview, has a covered call writing section, which is what we're going to be looking at in this video, but it also has a cash secured section for those selling cash secured puts. So you could use this calculator for either strategy. Now, we're going to take a much closer look. Let me just clear this away here. And we're going to feed all the information. This is the top portion of that spreadsheet, the covered call writing section. And you could see all the information from the option chain is fed in. The symbol of the stock, the industry, earnings date. You get that from the report. We also have ex-dividend dates. I didn't show you that in the report, but it's there. On the right side of the report, the price of the stock, the option premium, the strike price. How many shares did we buy? TSM, remember, was 300. And when do these expire? Well, they all expire on September 4th. They're all slightly more than a month out. So that's the information that goes into the blue cells of the Elite Plus calculator. Now, once we enter that information, the white cells and the yellow cells become populated. Let's stick to TSM now. We're not going to go through all of them. So we start out with the time value. Well, since that was an out-of-the-money strike, it's all time value, 270. All the out-of-the-money strikes have no intrinsic value. Intrinsic value is only for in-the-money strikes. And we do have one. I'll show you that in a second. Upside potential is how much can we make per share if the price of the stock goes from current market value, in this case 80.19, up to the 82 strike, another $1.81 per share. Now the break-even column is always the price of the stock minus the entire premium. The RU is the initial time value return. In this case, 270 divided by 80.19, and that's 3.40%. So that's our initial time value return for the 1 month option. Upside potential is the percentage more that we can make if TSM moved from 80.19 up to the 82 strike, 2.30%. So there's an opportunity here for a max return 1 month of 5.7%. Now, downside protection, that's not break even. That downside protection applies only to in-the-money strikes. And it's how much percentage can that stock decline and we still generate our full initial time value return. And we'll show you that for the in-the-money strike in just a second. Now, the RU premium is the amount of premium that we, time value only, that we generated times the number of shares. In this case, 270 times 300, $810 for that trade. We can make another $543 for this 300 share trade if TSM moves up to the 82 strike. The total invested is 80.19 times 300. Now, the yellow cells on the right give us our 20%, 10% guidelines when to buy back the short call. And some members like to use a 7% stop loss, so to speak, on the stock side. If it drops 7% from the initial value of the stock when the trade was entered, that might be considered a good time to sell the stock after closing the short call. So that's all the information on the out-of-the-money strike. Now let's go to the example of the in-the-money strike, which I showed you here for DHI, which was trading at 67.35, and we sold the 65 in-the-money strike, lower than current market value, for a premium of 440. Now the time value return is not 440 because we're going to lose 235 on the sale of the stock. So the calculator will deduct that 235, the intrinsic value component, to give us a time value return of 205 per share. Now there's no upside potential because we're agreeing to sell our shares for a lower price than the current market value. Break even is always price of the stock minus the entire premium. No difference there. So now the return on our option is 3.20%. That's the time value 2.05 divided by the strike price. We use the intrinsic value to lower our cost basis. So the 235 that we didn't use in our time value return, we do use to reduce the price of the stock from 67.35 down to the 65 strike. So the ROE is, in this case, 205 divided by 65, 3.2%. Now, the downside protection is how much the stock price can drop, in this case, 67.35, before we start losing any of that 3.2%. So it can drop down to the 65 strike, but not below, and we still will have retained the entire 3.2% 1 month return. Once again, the ROE premium is the time value times the number of shares, in this case 400 shares, times the 205, comes to $820 for that trade. And the total invested, again, is the strike price times the number of shares, in this case 65 times 400. So that will give us all the information for the in-the-money strike. And now we want to go to the lower portion of the top spreadsheet, which gives you your total portfolio positions. On the top here is individual, and down here is total. So total number of contracts is 21. You know, if you add up all these shares here, you would see that you have 2,100 shares. Total portfolio ROE adds up the ROE column over here, and it will give us $6,685. So that's how much cash that we generate from this column over here per trade. Gives us a total of $66.85. Now, if our positions all moved up to the strike price, it would be an additional $39.86. So when we structure the trade, our total portfolio return is $10,671 with upside potential. So that's the $66.85 plus the $39.86. That's the max return we could use without exit strategies. Now the total invested was $189,864, which means that our flat return without upside is 3.52%, and with upside would be 5.62%. And as we adjust during the course of the contract, these positions for the total contract will also change. Okay, let's clear that up here. Now, I want to point out that towards the bottom of the spreadsheet on the left-hand side, you'll notice those two purple arrows. And those are for exit strategies for the covered call writing strategy. One is the What Now tab for rolling the option, and the other is the Unwind Now tab for closing the position mid-contract. What is the time value cost to close? So we're not going to get into detail with position management, but let me just show you what the right side of these spreadsheets will look like. So when rolling the options, it will give you the what if I roll out return to the same strike. In this case, it was 1.50% when I use this spreadsheet. And then if I rolled out and up to a higher strike, we have to include the increased value of the stock. So when we remove the original short call, it tells us that in this particular case, we have an initial 2.70 time value return, and if the price of the stock moves up to the new strike, an additional return, which would then create a 4.25% 1 month return. So these two position management tabs, we moved over from the Elite version of the Element calculator and added it to the Elite Plus calculator. Now, if we go to the Unwind Now tab, which we would sometimes use mid-contract, it will tell us the actual time value cost to close, not the total cost to close, because as the strike moves deeper and deeper in the money, or as the price of the stock moves higher and higher and higher away from the strike price, the cost to close goes up, but it's mostly intrinsic value. It's the time value that we care about, because we can sell the stock and recapture that intrinsic value. So in this particular case here, just as an example, we're not going to get into the details of the trade, it showed us that the actual time value cost to close per contract was $6, which represented a cost to close of 0.17%. Now, we would use this and accept it if we can generate an additional 1% greater than the cost to close, or 1.17% or greater by the end of the contract. This information, folks, is in my books and DVDs under the mid-contract unwind exit strategy. Point here is that the Elite Plus calculator has these two position management tabs included, as well as the multiple spreadsheet for both covered call writing and selling cash secured puts. Let's summarize. Now, to create our portfolio, we use stock selection first, which includes screening for fundamental, technical, and common sense principles. We then do the analysis, and that's all included in the BCI Premium Member Report. Now, if you don't become a BCI member, we teach you how to do it on your own. Option selection, we have to choose an expiration time frame. I use monthlies. We have to decide on the moneyness of the strikes. I'd be more aggressive in bull markets or normal market conditions. I tend to go out of the money, and in bear or volatile markets, I tend to favor in the money strikes. We also have to define what our initial time value return goal range is. Otherwise, we wouldn't know what strike to pick. Now, first things first. Once we enter our trades, we immediately go into position management mode. Now, the BCI products that will allow us to craft our strategies in this manner are the premium stock reports, become a premium member, and the Elite Plus calculator, which we showed you screenshots of. So to get more information on this, go to our website, www.thebluecollarinvestor.com. For the membership, go to the premium membership link, and to find the calculator, we'll show you in a second, go to this store link. So here's what the premium member link will do. You could see, gives you a little information on the top. This is just the very top of that page. You could see towards the bottom of it, there are some videos, and there's a lot more information below that. I can only show a certain amount on a screenshot like this. Now, if you go to the store link, you will see a page that looks like this. There are additional rectangles below it, but you will see calculators, books, video lessons, and so on and so forth. The Elite Plus calculator is located by clicking here, and you will see the Elite Plus calculator on the next page after you click there. And it's a brand new product as of August 2020, and I think the best calculator that we ever created. So, ladies and gentlemen, that ends this video setting up our covered call writing portfolios using the BCI Premium Member Stock Reports and the Elite Plus calculator. Folks, I hope you find this video useful. I hope you benefit from it, and I thank you so much for taking the time to watch it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.